We'll be looking at Chapter 3, Basic Financial Statements, this week. Now, every business, regardless of the type of business, has the same basic financial statements. The component pieces, that is, the line items, might be different within those financial statements, but the basic structures, purpose are the same. So let's look at some financial statement info that you might need as an individual. Now, before I proceed, I also want to make reference to the fact in the previous chapter I had referred to the small business entrepreneur class as Business Management 265, and it's actually Business Management 210, just so that you're not confused on that. So let's look at for an individual, for financial statements, the items that you might be looking at, especially if you are applying for a bank loan. A bank loan application form would basically be incorporating two individual financial statements. One of them is a statement of financial position. Sometimes you will hear that referred to as a balance sheet, and we'll talk about these component pieces in just a few minutes. But that'll have cash equivalents, whatever invested assets you may have. What the text is referring as use assets, but I prefer the term fixed assets, liabilities, and your net worth, your personal net worth. They'll also be looking for a personal cash flow statement, which includes your income and your fixed expenses and your variable expenses. So let's look first at an income statement that they're going to be looking at. The cash flow statement. Obviously, income is going to be income that you would include from all sources: wages, tip, overtime, any interest that you may have on savings or stock dividends. If there's been any income from the standpoint of trust payments or sale of investment assets or any of those kinds of things, you would include that within the period that it was actually occurred. The business equivalent of this statement is what is also referred to as an income statement. So your income are all your cash inflows. Then you're also going to be capturing your cash outflows, which include fixed expenses, which are contractual in nature, which must be paid. And these fixed expenses might be written contracts, they might be oral contracts, they might be implied contracts. Examples of fixed expenses are rent or mortgage payments, your insurance payments for house, for car, your utility payments, your car payments, et cetera, et cetera. There's also what's called variable expenses, which are expenses where you control the level of the expenses, your food and your clothing. And it may be that you can't necessarily not eat, but you can choose as to what you do spend your food money on, for example, eating out. So let's contrast that to a business P&L. A business P&L or income statement, I say P&L because that means profit and loss if you hear me refer to that. The basic format is the same for most businesses. It'll have sales, revenues, which is the income from doing business, and that will be net of any returns or allowances that you may put in place for that business, less the cost of goods sold, which equals gross profit. And this is really the first section of the financial statement. That cost of goods sold would be any cost of materials. For example, for a retailer, is going to be the actual cost of the inventory that you are buying. It would include freight costs and other costs of, in essence, getting that item ready to sell. For a manufacturer, it's going to include the direct manufacturing costs such as labor and other overhead that might be allocated to it. And so in a business income statement, in most businesses, unless they're a much simpler business such as the service industry, are going to have sales and revenues minus cost of goods sold, and that will equal gross profit, sometimes referred to as gross margin. And then from that gross margin or gross profit, you'll be deducting your operating expenses to get your operating income. And those operating expenses will include your fixed and your variable expenses that we've talked about before. Those expenses that were incurred that are not included up in cost of goods sold. And this is the second section of a P&L, which gets you down to your operating income. The third section of a P&L is that which eventually gets you down to your net income. And what you will do is take your operating income, you're going to deduct interest expenses that you're going to have on any loans or any debt that's expressly associated with the business itself. You're going to deduct that, and you're going to come up with a, well, here on the example it says net income. But if you happen to be a corporation of that kind of structure, it's actually going to be what's called EBIT, which is earnings before income taxes. And then you'll have one more section that will have this income before income taxes, or earnings before taxes is then you're going to have your taxes, and then you will have net income. And that net income, if you're a corporation, is what is then used to calculate what's called EPS, or earnings per share. Earnings per share is very simply the net income of the company divided by the number of common shares outstanding. And so what this does is this operating income this allows operating income to kind of compare from business to business as to what the cash flows are, what the profitability of that business is, without regard to either equity investments or financing or debt investments. Then as you work your way down, less interest to come up with earnings before taxes, is that actually allows you to compare businesses with each other before you're looking at what the specific is of the tax structure or the corporate structure or organizational structure you put into place. Now, also associated with the business is what's called a statement of financial position, or a balance sheet. And again, just as a reminder from your basic accounting class, the basic accounting equation for everyone is assets equals liabilities plus worth. And what you'll see here as an example is everything is the same no matter what kind of organizational structure you put into place, except for the equity or the worth area is called something different, and it's made up in something different. Just briefly to mention that there's something called double entry accounting, if you remember that from your previous course. This means that this equation of assets equals liabilities and net worth must always balance. It's just an algebraic equation. So if you do any sort of transaction, it's always this balance still must flow through this equation. So in the double entry is there's always two sides. So for example, if you have you may have something where you are increasing an asset by a certain dollar amount, and that means that your choice is you either must decrease another asset so that the equation stays balanced, or you must increase either liabilities or net worth on the other side. Now, obviously, this being an algebraic equation, you can have total assets minus total liabilities equal net worth, or you can move things around, but the equation must always balance. This looks the same for all organizations, all businesses, except for the equity section itself. And the way that the profit and loss statement flows into the basic balance sheet itself is the P&L accounts, the income and the expense accounts. You can almost think of them as a subset of the net worth, because in reality, they are accounts that are increasing or decreasing your net worth or your equity accounts. We just happen to, for ease of being able to see what exactly is going on, we actually pull those out separately to create an income statement or a profit and loss statement. And then once we get down to that net income line at the bottom, we then just post that net income line to the equity or the net worth section. But again, double entry accounting just means that everything must stay in balance. So let's discuss some of the more common components that you are going to see in a balance sheet or a statement of financial position. First of all, you'll have what the asset side, and you'll have the category called current assets. Current assets are basically those things which are going to be either liquidated or are currently convertible to cash, something that is going to be convertible to cash or cash-like instrument within the next 12 months. So that will include cash, marketable securities, accounts receivable, which are monies that are owed by customers, and of course your inventory. Fixed assets are those assets which are not readily convertible to cash. They're not considered to be a cash or cash equivalent type of asset. And that includes land, building and equipment, and you get a net out of the building and equipment. The building and equipment is you reduce it by what's called accumulated depreciation. And all depreciation is in essence a way of quantifying and reducing and booking the usage. For example, if you buy a truck and for the business and you anticipate that that truck is going to last for 5 years before it's no longer useful for the business anymore, you are going to write that truck off over the next 5 years, which means if you bought it for $20,000, you're going to record usage of it, and it might be an equal amount of $4,000 a year. You'll reduce that amount. And again, double entry accounting means that you're going to reduce the asset by $4,000, but you're also going to be on the other side, you're going to be reducing then your income or your net worth by recording an expense. And I don't want to get too much into double entry so I don't confuse you. You'll notice here that land is one item that does not have depreciation associated with it. And that is because theoretically land never gets used up. It might be used, but it's never used up and discarded. The only exception are if there are things, for example, land that is purchased to be mined where the ground is actually depleted, and there's a separate category and separate treatment for those kinds of items. As you continue on the balance sheet equation where assets equals liabilities, on the other side of the equation are liabilities. These are all the monies that you owe. Current liabilities are those monies that are owed within the next 12 months. That'll include accounts payable, which are just your regular items that are payable to just doing regular business. Notes payable is if you have a promissory note that is due. That's notes payable. And taxes payable, of course, are any taxes that are due, whether they're income taxes or payroll-related taxes or property taxes or those kinds of things. There's also a category that's not on here called accrued expenses. And accrued expenses are merely a way of recording at the end of a period, recording that you recognize that you owe money to somebody, but you may not actually have the bill in hand. You haven't had a chance to process it yet. For example, you may know at year end that you have a large utility bill coming that runs through December 31st. But you haven't gotten it yet, and so you're preparing your financial statements, and instead of underreporting what your utility expenses are, you will just do an entry to say, well, we're going to record the expense and we're going to put it out there as an accrued expense, recognizing that there is a liability that we have incurred that just hasn't made it through a processing it as an actual invoice through accounts payable. Also, you'll see this with other kinds of expenses, especially in payroll area. Sometimes payrolls, if payrolls run through December 31st, the payday may or may not be on December 31st. It may actually be paid out at the beginning of January, but you would again want to record that expense when it is incurred in the month of December. So that's another item that you may see. Long-term liabilities are those which are due more than a year, more than 12 months out. You may have a debt, a note that actually has two components to it. You may be paying off, for example, a mortgage. There's a certain amount that you're paying off over the next 12 months, and then there's another amount that's beyond 12 months. The current portion, the 12-month portion, would be showing up in current liabilities, and the long-term portion, of course, would be down in long-term liabilities. There's then also the section called equity or net worth. And again, this is there's various components, and I won't go into too much of the details of what these components are. But for every corporation, there will be common stock. that may or may not be issued, but it would be recognized out there. There is something called preferred stock, which means in the case of liquidation, the holders of preferred stock will get a liquidation preference, and there's also a few other things that can go along with that. Paid in capital is if your par value or your stated or your face value of your stock is, for example, $1, but you sell that one stock to somebody for $100. That $1, the difference between the $100 you sold it for and the $1 that is the face value, that difference of $99 would go what is called paid in capital. And then retained earnings is merely the accumulation of your profit and loss from the beginning of time. So if you made $10,000 last year and you made another $5,000 this year, your retained earnings, your profit and loss accounts in net would be $15,000. And this will go up and down depending upon what your actual P&L is itself. The balance sheet, and one of the things to recognize is the balance sheet and the profit and loss statement do not show for most businesses how cash has moved in or moved out. Because for every business it's using what's called accrual accounting, which includes accounts payable and accrued expenses and those kinds of things. If it's not a pure cash accounting, which is not considered GAAP, generally accepted accounting principles, you don't necessarily have a real good understanding for your cash flow in the statement. And the relevance, I'll just give you an example of that. For example, in accrual accounting, revenue, you are required to record it and recognize it when it's earned, not necessarily when it's received. So you may actually record $100 a sale, but you may not get the money for that $100 a sale for a couple of months later. And of course, that has a direct impact on your cash flow. In the same respect, expenses is you record them when they're incurred, not when they're paid. So you may have a bill from a vendor that you have received that inventory and you have taken and signed in that inventory. It is now yours. You have an obligation to pay the bill for that, but you may not pay it for a couple of months. So there is a statement that reconciles the activity of your cash itself. It recognizes what cash was at the beginning of the period, let's just say beginning of the year, and what cash is at the end of the year, and tries to identify the component pieces that are contributing to where your cash actually is. So it takes these components within the financial statements and in essence reconciles them to the impact on cash. And that is called a cash flow statement or a statement of cash flows. It shows how the company's working capital flows in and out of the business during the year. So there's really three parts to this statement of cash flow. The first part is called the cash flow from operating activities. And again, these line items, just so you don't get confused, these are just the same information that is found in the balance sheet and the profit and loss statement is just configured differently for you to be able to understand what the impact is on cash. So the first part is cash flow from operating activities, which is the difference between all of the cash received by the business and all of the cash that is paid out by the business in conducting its day-to-day operations, whatever those day-to-day operations may entail. For a retailer, of course, it's just going to be the retail operations and all of the back office support of that. For a manufacturer, it's going to obviously be the manufacturing operations. So receipts are looking at all the cash that has come in from sales, which and changes in accounts receivable and changes in inventory. So let me just kind of briefly talk about this just so that you can understand this conceptually. Your slide here obviously says an increase in accounts receivable or inventory represents a negative cash flow. A reduction in receivables or inventory is a positive cash flow. And let me just explain that. Just step back and think about this conceptually. If the money that is being owed by customers at the beginning of the period was $1,000 and you had all of these sales that occurred during the period, and at the end of the period the money that your customer owes you is now $1,500, well, theoretically you're in a worse off cash position if everything else is equal. Because if your sales, it basically means that all the sales that you have made, that there are $500 less of sales that you've collected this year than you did in the past with respect to just the flow through. The same with inventory. If you go out and at the beginning of the year you had $1,000 of inventory, but at the end of the year you had $3,000 in inventory, theoretically you used $2,000 more of cash to build up your inventory, just like building up your accounts receivable. And conversely, it works the exact opposite. So you make adjustments for your changes in inventory, your changes in accounts receivable, your changes in other kinds of liquid accounts that are current assets or current liabilities, as to how that impacted your actual cash flow inflows and outflows during the period. In the same way, your payments, all payments made to the company to all accounts, including suppliers, employees, rents, utilities, if that balance in your current liability increased or decreased, that then has an impact with respect to what your cash flow was. The second part of the statement of cash flow is cash flow from investing activities. And this is looking basically at your fixed assets and either your acquisition or your sale of the fixed assets. And the slide here says plant assets, which obviously comes into account if you're a manufacturer, but those assets may be, if you're a retailer, it just may be fixtures in your store. It may be office equipment that you've recognized as fixed assets. And so you're going to be looking at if you went out and bought fixed assets, you bought a truck, for example, for the business, that's going to be using up your cash. In the same respect, if you sold a truck that you had in your business, you now are going to be having an inflow of cash from that particular activity. The third part is the cash flow from financing activities. And this is looking at all of the changes that are happening in your equity accounts other than those that are directly related to your retained earnings or profit and loss accounts. And it might include your long-term debt, and it might include bonds, it might include your common stock or preferred stock movement, all of those kinds of things that in essence kind of fall outside of the day in and day out operations of the business itself. You then get at the bottom, you then are reconciling, you'll get a net increase or decrease in cash, which you can then take and apply against the cash balance at the beginning of the period and compare it to the cash balance at the end of the period to have what is really just a reconciliation of your cash account itself. Now, I also want to mention, because the book mentions something called free cash flow. And what free cash flow is looking at just your operations, and it's excluding your finance activities above, and it's including things like depreciation. And the reason is depreciation and amortization expenses are non-cash expenses because the cash was incurred to buy, let's say, for example, the truck. But as you're writing that truck off, there is no cash that is going out. The cash already went out previously. So it's cash that is coming from your basic operating activities itself. And the reason that this particular looking at the cash flow statement in this particular way is when you get down to the bottom, it really kind of gives you an indication whether if you're going to need additional infusion of capital into your business. Because if it's negative, you're going to need additional financing, or you're going to need somebody to put more equity dollars into the business to keep it going. If it's positive, you don't necessarily need those additional dollars just to continue operations into the next periods or the next years. So free cash flow is really a way of being able to evaluate where you are from year to year with respect to the adequacy of your underlying financing, whether it's coming through debt or coming through equity, to determine is it going to be adequate to keep the business afloat, especially when you're in a startup phase, trying to go through to get to those periods of profitability. Next week, we'll be looking at Chapter 4.